Good evening, good afternoon, or good morning, depending on where you are on the globes now. A warm welcome to this new edition of the EAXIS Forum webinar, co-organized system with the Council on Economic Policies. And today we will talk about systemic risk from climate change and the potential macro policy to address them. And for that, we have the pleasure to welcome Paul Hiebert from the European Central Bank, who will present a new European Systemic Risk Board and ECB report on this issue, and Steve Cecchetti, who is, among other acts, chair of the Advisory Scientific Committee of the European Systemic Risk Board. And he will discuss Paul's presentation. Before we dive in the presentation, let me just say a few words of context. There is quite of a wide agreement among financial supervisors now that climate risks are potential systemic risk. This is a fact that has been highlighted by the NGFS, the Central Bank and Supervisors Network for Greening the Financial System, for example, or by the Financial Stability Board, among others. And now, if we have potential climate systemic risk, then the question of an adequate macroprudential policy response to mitigate them naturally comes up. And Paul will highlight some of these macroprudential options in the context of a report from the ESRB and the ECB that has been published at the end of last year. I would like to say that this report is the latest of a series of, I think, 4 comprehensive reports, if I'm not mistaken. And all these reports throughout 4 years have, I think, documented a lot of what we know about climate risk in Europe. And these reports are really a wealth of information, at least for me, so I can only recommend to read them. A last word of context before the discussion. I think it might also be important to remind what are the goals of macroprudential policy as defined by the single supervisory mechanism. So basically, macroprudential policy seeks 3 things. Prevents the excessive buildup of risk in the system, makes the financial sector more resilient and limit contagion, encourage a systemic-wide perspective in financial regulation to create the right set of incentives for market participants. So that is the background. I will introduce the 2 speakers more formally just before the presentation, but before that, maybe we can run our usual question at the beginning of the seminar. If we can launch that. So 2 questions about macroprudential policy. One, what is the best macroprudential policy strategy to address potential systemic risk? We'll give you a set of answers. And the second question is, what are the best macroprudential instruments to address climate systemic risk in the banking sector? So I'll give you a few minutes to answer what you want. And maybe in the meantime, I'll introduce Paul Hiebert more formally. So Paul heads the Systemic Risk and Financial Institution Division of the ECB. And in this role, he leads a systemic risk analysis for the euro area, feeding into the ECB flagship financial stability review. And he also so the analysis as well as macroprudential policy for largest euro area banks. Paul also shares the ESRB and Analytical working group, as well as a Eurosystem macroprudential analysis group. And in recent years, he has led a lot of the climate-related initiative in the ESRB and Basel Committee on Banking Supervision. So I hope you had time to answer. So for the first question, which is the best macroprudential strategy? The majority is on saying increasing shock absorption capacity of the financial system and also use macroprudential instrument to support the transition. Almost 60% for that. Only 13% for nothing. And then which macroprudential instrument, systemic risk buffer first, and then concentration limit and exclusion of some economic activities on the second position with twice as less vote. and no macroprudential instrument is adequate, about 20%. So I'll give you now the answers, I think. I don't know if you have seen them. Paul, after reading these results, I give you the floor to present us the report from the ECB and the ESRB. Thank you.
Thanks so much, Pierre, for the introduction, and also the interesting poll to get a flavor of what the participants, the attendees here view as the best strategy or instruments to deal with the issue. I'll actually talk about both, so it's a great set of questions to kick off the discussion. So with this in mind, let me then move forward and just share with you, I think Pierre already did, some of the elements of what was actually behind this work, where the origins. And I was back in 2019, some time ago. We embarked on a journey of effectively trying to use the Eurosystem and European Systemic Risk Board's institutional reach and some knowledge that is inherent in this to gather evidence, numbers, to underpin eventual policy reflections, but also to better understand and gauge financial stability risks that would stem from climate-related financial risk. So in so doing, you have to recall, I think, in this respect, that the European Systemic Risk Board is a fairly large body. It has not only all of the countries in the European Union, 27 countries, it also has these so-called European supervisory authorities, which would be the ones dealing with insurance, banking, and markets, respectively. But also the European Commission has in its ranks environmental scientists, which has been very helpful for us. All of these people participating on a best effort basis to get us to more numbers to underpin the debate. So with that in mind, as Pierre noted, we've been publishing as we go along. Our goal is to be incremental, put numbers, put our thinking into the public sphere, and generate debate, feedback, which also helps us, I think, in our quest to better gauge, understand the financial stability risks, and craft some macroprudential response. So with this in mind, what I would then move to is just give you a bit of a flavor of what I plan to go through today. As Pierre mentioned, the report is quite some pages in it, and I think it is comprehensive. I don't want to obviously get into the nitty-gritty, but rather provide an overview of the main issues that we were tackling on two fronts. One is, how do we construct a financial stability surveillance framework which is amenable to a cross-country application, given the European Union is 27 countries and the euro area that shares the common currency, 20 countries. How could we put those types of elements into a framework which is both, again, consistent across countries, but also scalable, where we're learning more as we go along about a variety and suite of indicators, and how can we also grow those indicators into a framework? First element. The second element I'll turn to is going to get to the questions you had at the outset in your poll, more about macroprudential policy for climate. Can we devise, on the basis of the evidence we've selected, then a strategy, and also how we operationalize that based on existing instruments? So let me kick in with the first, and that is just this idea that a framework for financial stability surveillance would effectively be comprised of three parts. So the first is on the climate side, in green, as you see at the top, and that's this idea, what scope are there for shocks? And those shocks, largely we could think of in this respect as exogenous to the financial system. So one's coming from physical risk, so from global warming, and one's from transition risk, so from the intensity of policy, technological change, sentiment in the system, that could destabilize financial stability. Second block in the yellow is about the exposures of the real economy and the financial system, so banks in particular, to these risks. And then the third block is just taking these exposures, which give us a sort of, if you will, range of how the risk could play out, to having a much more of a forward-looking view. How could you go from exposures to actual risk? How could you interact financial vulnerability, or the projection of financial vulnerability over the projection of those exposures through time? So I'll talk about each in turn now, and give you some examples of indicators we're looking at. Some of them are obviously listed, obviously, as here. The current suite of indicators we look at are indicated in this actual table. So the first is really going to be down to climate shocks. And I'll maybe talk about three aspects of physical risk and maybe one about transition risk before we move to exposures. So on the side of physical risk, the first thing to note is that climate shocks are becoming largely unavoidable, insofar as they are in a global baseline. So the environmental scientists have basically converged around a number of 1.1 degree warmer temperatures compared to pre-industrial norms already is in the baseline. It's not a risk, it's in the baseline. So it is, pardon the pun, but baked in, if you will, And all we can control at this stage is the further rise in temperatures. And those implications then, particularly in an area like the Euro area and a European Union, may be rather heterogeneous across countries. Now, what we see is if you take, and that's heterogeneous because of geography and also because of the hazards resident in regions, which I'll come around to. That means, the levels of temperatures we're looking at in the current policies type scenario, so this RCP 8.5 SSB 5 scenario of scientists, it gets us the area where we're looking at much, much warmer temperatures across the Euro area, across the European Union, and in fact, rather starkly hot levels of temperatures in South and Southeastern Europe. But I think what's rather interesting is on the right-hand side is that this, containing the rise from, again, the most optimistic scenario, which is this blue triangles, is going to be the goal. And even those blue triangles are rather heterogeneous across countries. The further north you move, the more the temperature increases will be, which is just a function of environmental science. And sometimes those ranges of temperatures could be rather large. We're looking even at a 10-degree warming scenario by the end of the century. Now, what's important, I think, to understand as we move into this range is that there could be also some non-linearities or amplifications as we move along. So we often think about acute physical risks, so storms, we think about droughts, wildfires that we're witnessing more and more. But with time, things like sea level rise, so chronic physical risks, seem to be also lingering and lurking, such that we see global sea temperatures rising almost 1 degree compared to, again, to pre-industrial norms. And consider the Earth's planet, the surface is 70% water, so that's significant. And then you have this idea about polar ice melts here in the Antarctic, which is going to add, obviously, to the effect of the freshwater mix and saline water, and also change potentially ocean currents, which could, again, trigger nonlinearities. Now, what are we concerned about here? Well, this is this idea that we already here, again, baseline, not risk, in terms of warming temperatures, so up 1.1 degrees. And as you move along, you see that we're already in this sphere, which climate scientists would let us know are in the sphere of tipping points. It's in this range, which could tip us into nonlinearities, areas where we have less certainty, less understanding of how this risk could play out. So this risk could become a bit more unruly as we move forward, notably if the temperatures that we're witnessing rising start to rise to higher levels. You'll see some more of these tipping points start to be breached. But important to note, already now we are in the range of these tipping points. So again, climate scientists have difficulty telling us exactly what might happen in such a scenario. And I think we need to be ready for some shocks, which are hard to predict, if you will. Now, if I switch over to transition risk, what is true, and I think also, is that we are reaching a point where some of these transition risks, which we thought might be long dated, are actually sooner than we think. And the reason is 2030 tends to be a year which is associated with climate commitments, the first phase. And as we reach that year, we start to see some backloaded commitments start to become more binding. If you look at a net zero scenario of the Network for Greening Financial System, so to keep us on a 1.5 degree trajectory, we're looking already at the share of renewables and biofuels in our energy mix in the Euro area, so the 20 countries of the common currency doubling, not 20 years hence, 5 years hence, next year. If you look also at a Fit for 55 package, which is a European package aimed at also containing global temperatures through transitions, you see also even by 2030, we're looking at quite a sharp share increase in renewables and biofuels. And I think what's important to note is the right-hand side chart here, which tells us across countries, we've selected 5 in a common currency: Germany, Spain, France, Italy, the Netherlands. You see rather different adjustment intensities in energy mixes. So Germany would be much more about in renewables and biofuels. Netherlands, on the other hand, is very little in that category, and it starts to be much more about reducing other elements like coal and waste. Whereas in France, nuclear is a big part of the energy mix in all contingencies. So clearly, that heterogeneity is important to understand in any cross-country framework and understanding how shocks might play out in the transition side. Now, with that in mind, let me switch over expeditiously to the exposures side, which starts to move now away from this climate science, away from the policies that are outside the financial sphere into more the financial sphere. Where do we see the exposures on the real and financial side? So our work thus far has brought us to be very granular. Around 3 million geolocated Euro area firms, around 4.7 firms worldwide. We have address level susceptibilities through a third-party provider to give us information on what productive facilities could be hit and what types of physical hazards might be important. So wildfires in the southern part of Europe, southeastern Europe seem to be more predominant. If you see each dot here is a firm, and over the next 20 years, what types of risks they might face, so high or present or increasing exposure. And in Central and Eastern Europe, much more about riverine floods. So again, the type of hazard is quite regionally relevant, even within countries, and we need to be mindful of that granularity when thinking about the incidence of physical risk. The right-hand side chart just gives us a notion of insurance protection. What is the current degree of insurability of these climate-related hazards? And work we've done with our insurance supervisors suggests at the country level, here we don't have quite the granularity at the regional level, is that only around 25% of climate-related hazards are insured today adequately. Meaning, the majority are either under or uninsured, and that goes down even in some countries to only 5% are currently insured adequately. And with time, of course, we can expect premia for insurance or availability to possibly, if anything, become more challenging. So with that in mind, the physical risk side, a lot of it resides in the side of insurers, and I'll come back on the macro-pru part in the second part of my presentation, where we think some measures might be actually helpful. On the side of transition risk, it seems to be much more about banks. They have a lot of the carbon-intensive exposures within their balance sheet in terms of financed emissions. And they are, in a sense, key custodians of transition risk reduction. And if you look, though, at the aspect of firm lending by banks, thinking about exposures, there actually is no one unique measure of how we would look at this. In fact, I can present you at least four. The first four rows in this particular table. The first is this overall balance sheet, so average weighted carbon intensity or bank carbon footprint of lending. So all loans, all securities may be normalized by outstanding volume. The next is about sector concentrations. I'll come back on that because that's the chart you're going to see on the right. The third is if you get down even more granularly into activities. So taxonomies currently prescribe what would constitute a green or a transition activity. We could even get into that level. Or the fourth is here about bank level concentrations. We might think about particular banks have strong concentrations and those need to be managed closely. All four of these will be part of our thinking in terms of exposures. And the right-hand side chart just gives you an impression in terms of the tilt that banks tend to be overweight industries which are more emissions intensive, around 73% by our computations. And that you can see from the yellow bars here, which is a loan share towards particular sectors of banks, compared to the gross value added share in the blue bars. And you can see here that some areas like real estate, energy, transportation, agriculture, those tend to be areas where banks are overweight in terms of their lending compared to the economy. And they're underweight in places like communication, scientific health, education. So in a sense, banks will need to manage those particular emissions exposures with time as we move forward. The other element, apart from firms, of course, is households. Here we have generally less granular data, so we've been trying to delve into what we can with survey data. So the left-hand side just gives you an idea about how we're moving this survey data into CO2 emissions, resident in this case, and household mortgages. And that's in the right-hand side chart by country in the euro area. So these are country codes in the x-axis. It's just telling us what are the mortgage exposures to high-emitting households, high-emitting households in this respect, when it comes to your energy performance, if you will. And what we see here is around 6 countries below 60%, but around 8 above 70%. And in general, you see quite a block of countries with pretty high emissions exposure. Again, needs to be managed by banks as we move forward. So banks will need to manage both their corporate and their mortgage lending portfolios with the emissions down through time. Now, just before moving away from exposures, I wanted to note that we have done some work this edition on thinking about broader risks from nature. It's something that was requested us in the European Commission to better understand this risk. So we did some exploratory work. And this starts to be a broader in a sense that it's also getting into harder to measure elements. Climate, whilst it's ostensibly about temperatures, emissions intensities, when you get into nature, it's much more broad in terms of water availability, one strand, so groundwater, surface water, the quality of water, water flow maintenance. On the other hand, about biodiversity, soil quality, and then some other elements related to ventilation, so airflow, it comes from carbon sinks and the like. I think in this, looking at this, of course, some of these seem a little bit distant, but if you look more closely, there's so-called ecosystem services, which do come from nature. And some of them are not just in places you'd suspect, like agriculture for water, for instance, or soil quality for agriculture, but you could think also about manufacturing, and even industries like tech need a lot of water to cool data centers. So water becomes quite integral to a lot of production processes. And the integral nature is actually borne out by a look we did initially, similar data sets to what we had on the climate side, but on the nature side, looking at different ecosystem services, and not in a sense of utility in terms of enjoying nature in its broader sense, but just economic and financial exposures to this. And here what we see is effectively banks have a relatively high bank lending, that is, bank loans, high exposure to corporate sectors at risk of nature degradation. And it's in terms of mass stabilization and erosion controls. Think mortgages are a big part of banks' balance sheets, but also water, surface, groundwater, and flood and storm protection. Maybe some of the other elements like one's pollination, animal-based energy, these things are a bit more distant. So in fact, it's really about these top elements here. And insurers, we see around, again, 31% of their investments seem to have a high dependency on at least one ecosystem service, mainly surface water, groundwater, and flood and storm protection. Perhaps not surprising given insurers at the heart of this. So with these exposures in mind, the last block I want to look at is that of risk. And here I just note that anytime you're looking at risk, you want to think about financial and vulnerability and climate exposures intersecting. You'd want to do it in a forward-looking way. And this is why we generally are looking at climate scenario analysis. Here I use synonymously with climate stress testing, just for the purpose of thinking about severe but plausible scenarios as one means of generating those. And we tend to be here in the Network for Greening the Financial System, probably familiar to many of you, these scenarios of a net zero transition, which is orderly, starts soon, and goes effectively in a way which is relatively moderate, but distributed through many years, through to a rather jarring late adjustment or no adjustments, bringing us to very high temperatures. What's true is the ECB's run a series of exercises. I've linked them all here. The slides will be available after the seminar. But just to give you a thinking about what these scenarios look like, and there's not one, I'd say, canonical scenario analysis giving us all the answers. We're looking at a composite picture based on different questions we can ask with each. We had some top-down exercises at the ECB. One was this 30-year horizon exploring physical risk, transition risk trade-offs. What are the actual elements that come from early action in terms of physical risk reduction? What might that entail in the short term? And what we see is there's short-term pain, which is relatively limited for a lot of long-term gain. But then we also did a second one just last year on short-term transition dynamics, 3 to 8 year horizon, a bit more actionable in line with politicians or in markets, which might have a less of a sort of long-term view with wide error bands, but maybe nearer term. And that looks just more at the energy transition in the near term, since physical risk is probably less likely to manifest itself in a particularly malign way in near term compared to what we'll see in decades hence. And we also did a supervisory exercise for banks, again listed here, complement to the top-down. And our work has been about system-wide. So as Pierre mentioned at the outset, not just thinking about banks, but thinking about insurers, thinking about also asset managers in the mix. Now, I think with time, just to note, conceptually here, what we've been interested in is compounding risks, thinking more and more about how could risks interact in ways which also generate modeling challenges that we have to also upgrade and think about our models as they currently stand, or also how we run these models. So the shock compounding element here is really about making use in the nearer term of an adverse scenario we tend to have from a standard stress test and interact it with climate risk shocks. And this benchmark scenario here, we have some sectoral breakdowns. I've already tried to indicate we have a lot of heterogeneity across sectors, across regions with climate risk, and investment which we needed to also retrofit and update infrastructure to be also compliant. Now you could also layer on an uncertainty shock if you like, but even if you look at the right-hand side chart, some of the preliminary numbers we're running suggests you have this direct transition risk shock in the context of adversity, which is the yellow part is the adversity, blue is a direct transition shock, would be obviously meaningful for those fossil fuel intensive parts of the economy, fossil fuels, mining and quarrying, in the industrial breakdown. But if you look at the adverse scenario, if you actually had to transition with more vigor in an adverse scenario, you could see that across the board in many industries impacted. The other elements of amplification we've been considering is, I may maybe list 3 here, is one is an open economy idea. So if you take physical risk, it's likely to be relatively limited in a place like Europe, the direct climate shock, compared to say other regions like South Asia or Middle East, North Africa. But since the euro is a very open economy, through input-output linkages, global value change, you could see spillovers of physical risk shock. So that's one area we've been looking at, trying to better understand. Here using a private provider of GDP at risk, linking it through input-output tables, and seeing if you had an elasticity of trade substitution. I'm just giving you bounds here, which are rather extreme, no elasticity, so 100, effectively 0% trade reallocation capacity, or 100% frictionless allocation could give you some ranges in terms of how would those foreign shocks feed back and play into the idea that physical risk shocks actually can spill over across borders through global value chains. And it gives you some impression, again, places like the euro area, you might see relatively important amplifications, even without, when you didn't have many frictions in the mix. The other element was about the idea of overlapping portfolios. which would mean that sometimes we hear from the industry, well, we'll just dispose or downplay our exposures when the time comes. But what if they're all selling into the same in the same salient shock, which pushes everyone to sell at the same time? Obviously, we can create self-fulfilling mechanics, fire sales and the like. What we see is investment funds and insurance corporations tend to have relatively high portfolio similarities when it comes to country hazard-related risks, so physical risks. Banks may be a bit less because they have more idiosyncratic elements in terms of their lending. Last but not least, the amplifying feature I'll turn to before I turn to policy now is this idea of risk transfer. So I talked already about under or uninsured elements of the physical risk landscape. And of course, the sovereigns might face the irresistible temptation to step in and take care of some of these risks, not just for arm's length straight-on enterprises in the utilities sector, but also some, if you will, implicit commitments or even unfunded commitments towards transport, manufacturing, or towards the financial sector, which we've often seen in the past. Not just physical risk hazards, but also transition risk ones. We need to be mindful of this idea that there could be also scope for amplification through risk transfer. Now, with all these in mind, I'm mindful of the time and I want to leave enough for the discussion of Steve, is the macroprudential policy options that follow from this. Let me briefly tour through this just to round out the presentation before then handing over to Steve. So on the policy side, given all this evidence I presented, I think you can think, well, what would be, first of all, the rationale for a macroprudential approach to climate change? And not surprisingly, we invoke market failures. So any environmental economics amplification will be there. But in fact, also, if you think about in general policy scope, it's about these things. What are the systemic risk channels from macroprudential? Spillovers, nonlinearities, interconnections for risk of late response underestimation. Climate might have also some specific features. So I've been at pains so far to talk about concentration risks, elements of correlations of risk, which might be unusual, meaning diversification is difficult, irreversibility of some of the elements, and also this idea about underpriced elements which lead to risk buildup. So again, getting back to the poll at the beginning, obviously there's the element of risk, resilience of the entire system, not just a particular sector. But also this idea about thinking about the buildup of risks. How do we manage this process? Obviously, the process will be a function in the prudential space of both micro and macro. So you can think of microprudential policy handling the idiosyncratic risks in any of these given sectors, banks, markets, or non-banks. We're talking mainly about insurance companies, pension funds, asset managers. So that in mind, that's obviously a microprudential prerogative, and work is already underway, a lot of it. A holistic approach would also have the systemic risks in tow. We think about spillovers, feedback loops, and also with vis-a-vis the economy. So I think these are the areas where we're currently quite strongly investing in better understanding what will be the prudential response to deal with financial related risk, which stems from climate. Now, with this in mind, the general strategy we would lay out is here resident in this table. So we'd say you need to think maybe about three moving parts in devising a macroprudential strategy. First, lender vulnerabilities. Here, think mainly about banks. Absolute risk versus relative risk. So concentrations I've tried to emphasize, regional, sectoral, within sectors, would augur for relative risk containment. Of course, you could think climate represents a potential risk for the entire system, therefore requires more absolute risk management. I'll come in the next slides to thinking about this. That's more about, if you will, the stock of climate related vulnerabilities on balance sheets of banks or other lenders. Borrower vulnerabilities could be also ones you could consider to contain the flow. So elements related to loan to value, debt service to income, loan to income. The actual end borrowers, what vulnerabilities in the financial side do they have, which again could interact with climate going forward and generate loss. So again, one we might lean on as a complement to the element of dealing with banks themselves. And last but not least, the non-bank sector, dealing with this insurance issue, and also informational failures where work is underway to also ensure that markets, whilst you can argue one whether they're allocatively efficient or not, certainly informationally there still are some inefficiencies which need to be addressed and are being addressed. Now, policy options are listed below, and I'm going to walk through some of these in the coming slides to think about these two elements of macropru and how they could actually be operationalized based on the current instrument set we have in hand. And let's start with the first on the lender side. So I think it goes without saying, and we took this from a really great Fed paper by Olsher, Styro and co-authors. They looked at the idea, why would we want capital? Just the conceptual case. Would you expect climate risks to increase the median shock or the volatility of shocks going forward, or both? And I think you as a listener can decide what you think would be the case. Personally, I would tend to think at least the volatility is higher. If the volatility is higher, it might be that provisioning by banks is not sufficient. You need to think about unexpected loss. Unexpected loss, maybe by extension, then more capital. And I think part of the question we're grappling with, and this is still work in progress, is how do you design, if you were to invoke capital requirements, how would you design us to avoid suffocating transition finance? So banks, again, being custodians of a lot of high emitting firms, you'd want to manage that down in a way which is effectively not creating a macroprudential problem, which is creating lending stoppages, but doing so in a way which is also sort of, if you will, not about if capital is needed, but when. And how would you invoke those measures? So some elements versus, not maybe pushing things out in terms of exclusion, but thinking more about tilting could be ways to implement that. Now, if you look in more detail, what instruments might you use in the set, in the capital space, you can go from one end of the spectrum through pure macroprudential again, Pillar 2 measures, taking minimum requirements, ensuring you have adequate additional loss absorption to deal with climate-related risk. On the other end of the spectrum, you have a systemic risk buffer, which is broad in its application. And broad, I mean a general buffer applies to all banks, so that's this granularity element, or the scope to all exposures, and not just targeted exposures or selected banks. Now, admittedly, these two extreme options can be helpful, but you might think of an intermediate set of alternatives. One is about dealing with granularity, which is, you deal with banks themselves in a much more targeted way, or maybe also in terms of the scope of climate-related relevant exposures. You'd want to tilt those towards some of the ones which are more difficult or concentrated. Now, I won't get into the details here. You have a reference to a paper which is coming, but it's just to note there is, in operationalizing, you can think of it as a general way you'd normally do a stress test. An adverse scenario versus a baseline, you'd have buckets, and you might have a calibration factor, which helps you with uncertainty in terms of phasing in measures with time, rather than having them in a sort of upfront way, which is rather stark. Now, the other branch is going to be on the lender side, banks maybe in particular, is about concentrations. What if we were to not use capital per se, but rather if you Winsorize or censor the distribution of very, very high climate risk exposures and bring them back to the 75th percentile of the threshold across banks? What you would see there is loss reduction could actually be quite meaningful. So in this respect, this could be also an additional way to also trigger supervisory scrutiny or some other measures to try and bring down those rather big, large exposures, chunky ones, which could mean concentrations, real losses in particular parts of the financial sector you're more worried about. I talked about borrower-based measures earlier, so no need to go through this in detail. Just note, you can think of transition and physical risk both as affecting borrower solvency and also collateral values. In this respect, probabilities of default of borrowers, but also the losses given default. And there's some indications of what measures you might use: debt service to income, debt to income, or loan to value, respectively, in thinking about these elements. And again, it could be a complement to managing the flow of climate-related risks whilst you're dealing with the stock, which is resident in banks' balance sheets. Last but not least, just my penultimate slide before I get to the summary. Note, I talked about non-banks in two respects. One was the insurance sector, one was about informational failures. Informational failures, I think, is relatively well known. We've listed some elements here. I need not go through them in detail, perhaps. But rather, the insurance side, I think, is an interesting one. So if we do see a situation where we're under or uninsured in large parts of Europe, a very developed market in terms of insurance, what we might think about is what is the scope for private solutions to actually rise to the occasion, provide this insurance, thereby also helping ensure that the needed finances reaching parts of the economy, which are there, banks can manage physical risk too. What you'd see there is this ladder, is what we've listed out in an approach. We have the first rung is about private solutions to the extent risk is diversifiable, but that might be difficult because systemic risks are not systematic in a sense, they're not diversifiable. So you might need to move up to an element of reinsurance pools across larger regions. And that could also help, in addition to encouraging private sector, like catastrophe bond developments, where private sector has been a bit less on risk management solutions or tools like this, compared to, say, opportunities in the ESG space. The next rung up, you might think about public-private partnerships. So rather than have a blank check as a sovereign, when a climate risk materializes, I will just effectively have constructive ambiguity towards having ex ante limited liability and understanding how you could also supplement coverage with private sector as well as the public sector. And last but not least, in the EU, you could also pool across countries to the extent you think that any given country might have difficulty with diversification. So with this in mind, I will summarize very briefly what I talked to you about in a few words. The financial stability side, my presentation was centered around climate shocks becoming more virulent, likely becoming more important sooner than we might have thought formerly. Exposures are there, tend to be very granular in nature. And in a sense, financial risk is about projecting for these exposures along with financial vulnerability. Ineffective amplifiers maybe then, we need to understand these through our modeling apparatus. Macroprudential side, obviously there was a rationale about market failures, the strategy, which we include in a way which we hope to be able to scale up and discuss in terms of implementation modalities. And for now, look at some operational aspects of interest. Pass back to you, Pierre and Steve, keen to hear the discussion.
Thanks a lot, Paul. Steve, I think you have some slides, but while you do that, let me introduce you also more formally. So Steve is the Rosen Family Chair in International Finance and at the Brandeis International Business School. And he's also chair of the Advisory Scientific Committee of the ESRB, a research associate at the NBER, and a research fellow at the Center for Economic Policy Research. And also for you to know, before joining Brandeis, he completed a 5-year as an economic advisor and head of monetary and economic department at the Bank for International Settlements. I think I didn't forget too many things on your CV, Steve, and I'll give you the word for the header comment.
So thanks very much, Pierre, and thank you, Paul, for yet another very clear and concise presentation. I've been following this work partially in my official capacity now from probably almost from the beginning, and I think it's really terrific work. I really commend the report to you. I know it's 150 pages long, but there are you can read, I can tell you from my own experience, you can read sections of it without worrying about whether you're going to miss things either before or after. So if there are things you're particularly interested in, I really do commend them to you. But my job as a discussant and a commentator is not to praise the paper, but to serve Mark Antony's role, and especially since this is over, and so Paul really is at the end, and I'm sure he's grateful that he's there. So what I want to do is I really want to bring up a bunch of questions and things that I think that we ought to be thinking about. And the reason I want to do that is that I think that there are reasons to want to ensure that when we put these policies in place, that we do it in a way that's going to work. And that's both in terms of their design specifically and also their timing, because I think it's going to be very, very tricky to get this right. There are a bunch of things that we have to watch out for. I won't go into them in any detail, but just to mention a few things off the top. For instance, I think it would be a very bad idea to put policies into effect that would drive certain kinds of companies to split into two companies, brown companies and green companies. And if we're not careful, we might do that. It's also going to be very damaging and counterproductive to put in place policies that drive the brown parts and the carbon emitting parts of companies to parts of the world where people don't care. That doesn't help us. And finally, we have to always keep in mind that we don't want to put in place policies that stifle development in the low-income parts of the world. So I think that those are the things that I have in mind. Now, I realize this is a specific discussion about financial stability risks. I'll be a tiny bit more general, but let me just start where Paul starts. And Paul, I should say, this isn't Paul. This is an army of people. And these are people who are expert at what they were doing, and so this is not some sort of this is not some sort of offhand stuff that we're hearing or reading about. It's really very, very well done and detailed, and in that way, what they produced is a reference document that gives you the state of the art when they wrote it. So let me start with with what I would call climate-related financial stability risks as they're listed in the document. So first of all, there's this fact that a lot of climate risks are irreversible, so we shouldn't think about them in the same way that we think about a lot of other risks that we see. A lot of other risks that we see for financial risks, there's positive stuff and there's negative stuff. This stuff is ratcheting up. And so that's very, very important to keep in mind. It's ratcheting up in level, and as Paul suggested at one point, it is probably also ratcheting up in volatility. The second thing is that there's a lot of regional concentration of where these things where the impact of this stuff is. So, for example, you see countries or regions of the world that are particularly prone to floods, that are particularly prone to fires. These things tend to be concentrated and or to droughts, and as a consequence, if a financial intermediary is operating only in one region, this can create real concentration risks. It reminds me quite a lot in this case of rural agricultural banks in the 19th century that were lending all into one very small region, and if there wasn't enough rainfall or too much rainfall, the farms that had borrowed from them would all go under at the same time, and the bank would go right with them. It's exactly the same problem. Now, we can discuss whether or not what we want to do is create huge global banks to solve this problem. That has other downsides, so I'm just gonna stop there. The third thing that Paul pointed out quite nicely is that there are tipping points that create nonlinearities. This may be the case with other risks, but in this case, it's just obviously true, and so we have to worry about it. The fourth thing, which is related to the third one, I would say, is that there are problems in measurement, modeling, and that complicate risk management and risk assessment. And this is also related. The last three are in some sense related to the fact that there's just a huge amount of uncertainty about what's going on here. And once you start thinking about climate risks, you realize that that there just isn't that we just don't know enough. And so you can't, if you want to do risk management, somebody say, well, let's just write down the density function and figure out what we're supposed to do. Well, here, I think that's just very, very hard. So as I look at these, I can categorize them into two things. The first one I think are slow moving and pretty straightforward to handle. And I'll come back to like how we might in a few minutes. It's harder, by the way, to get to the point where you think that there are financial stability risks associated with slow-moving things, unless it's the case that those things are creating ever more uncertainty, which is probably true here. These right here, I would say, are conventional challenges for risk managers, although maybe they're just they're sort of the challenges are just bigger in this case than they are for the things that we normally think about. So I think that's the starting point for all of this. Now, is climate a financial stability risk? Now, the thing is that if I look at these and I say, well, systemic risk is something that happens sudden and fast, it's unanticipated and unforeseen. Is it the case then that climate risk is more gradual and slow and predictable and expected? So this is more of a question. It's not says this on the slide that way, but that is how I think about this as a question, and one that we really have to address. I'll come to that a little bit in a minute. But before that, let me just ask whether there are any new externalities here. I'm not sure they're new. They just might be, they might be, I think, further accentuated. And in a lot of cases, and I think you'll see this as you read the report, and Paul did emphasize the issue of these being financials. The climate risks are feeding through similar mechanisms in a lot of cases in the financial sector from of contagion and the like, and issues with incentives that we create otherwise. He didn't actually suggest that maybe this could increase the government subsidy to banks, but it could. And I think there I would be a little bit careful in thinking about insurance. If any people that are listening here want to think about climate risk and insurance, this is really just about who it is that's bearing the risk and how. But it may be the case that the government, and I think ultimately that's what's happening, is bearing a lot of the risk. And so to the extent that the banks are lending into areas that are at risk for climate, they may actually be benefiting from additional government subsidies when they do that. Now, the first one, you sort of asked, well, there may be some other things there. So this is my suggestion, Paul, that you can start working on population aging now that you have some time. And for me, I'm very interested in that. I actually think we should think about the financial stability risks of population aging. It's not really a joke, because I think it's a real thing. But I'm not sure that the externalities themselves are new. I think that they're just manifesting themselves slightly differently. So I think that what we're doing what we're really doing, and this is where I'm going next, and where Paul actually went, is you're saying that there are tools that we already have. So when does climate risk become a financial stability risk? I think there are two cases and that are pretty obvious. One of them is you have poor information and poor risk management. So on the information side, I think one of the great things that's been going on in reports like this and things like the NGFS is that we've been trying to provide more and more information to the supervisors and more information to the financial intermediaries so that they can price this risk properly and they can diversify it properly. I think this is actually a problem. There's also a problem potentially associated with the repricing of assets. And if I ask myself, how is it that I can address these? I can address the first one with better supervision, but I do need to think about it. It may be more of a micro thing than a macro thing, and I can address the second one through my solution to everything in the financial sector, which is capital funding, increased capital funding, and better stress tests. But this is capital funding that's related to systemic risk buffers. It's related to increases in uncertainty. It actually, in a lot of ways, for those of you that have thought about operational risk, this is an operational risk applied to something else. But we do need to keep it very much in mind. Now, what about the role of macroprudential policy itself? I think that there's some pitfalls here and things that I really do worry about. So the first thing is that you do want to focus on sources of systemic risk. Again, this is what the report does. This is where it goes. You want to be very careful, though, not in my view, not to use prudential tools as industrial policy tools. And I actually would shy away very much from risk weights and concentration limits. I don't think those are climate policy tools per se. I think those are something else. If you give people information and then they choose different fine. If you measure risks appropriately, that's fine, but don't artificially create green and brown risk weights or specific concentration limits just based on climate, because I think you're going to get yourself into trouble. Similarly, for borrower-based measures, I'm actually not a huge fan of those either. Remember, prudential authorities and central banks are not fiscal authorities. They're supposed to be guarding. They're not supposed to be shifting the focus of production and income in society. Let me finish here, which is a set of questions from a nice blog post by David Aikman and Robert Barwell. And I think that these are questions that I think that we have to be able to answer as we think about how to address financial stability risks that are arising from climate. So the first one is, why won't market discipline manage slowly developing climate risks? There might be there's the answer there probably is myopia. Will improved disclosure data and modeling help mitigate these? Yes, it will, but there's a huge public good aspect to this associated with pooling information and skill sets that only governments and possibly only central banks can do? Will the private sector withdraw from climate exposures too quickly or too slowly? I think this is a serious issue. I think we want to be very careful that they do not withdraw too quickly. We absolutely need to have some of these sectors in place so that we can finance and manage the transition and adaptation that we need. Will microprudential authorities fail? I'm going to finish.
Yeah. Sorry.
Climate risk adequately. I think they can go. I think you have to be very careful about going too quickly. And I think because if you do, you could mess everything up. Will microprudential authorities fail to address climate risk adequately? Here, I hope the answer is no, but I'm worried. Is there a risk of a green finance boom that's fueled by imprudent lending? There again, I think we have to be very, very careful, but it's up to the microprudential regulators. Will carbon-intensive firms that are essential in the transition be starved of financing? I think that's a yet another risk. And the final one is you have to be very careful if you start doing this, that people are going to start wanting to use macroprudential tools for fixing all of society's problems. And I think again that's a serious risk if you're not very careful. So thank you again. As I said, this is a report that I have a tremendous amount of respect for, and Paul knows that I've been very supportive of this along the way, and nipping at his heels at various points. But I think that it leads us to a new set of questions, possibly ones we wouldn't have been able to ask before that. So thank you very much, and I look forward to the discussion.
Thanks a lot, Steve. So I just remind also the audience that they can, for the little time remaining, asking question on the Q&A. There is already one. Paul, I read it to you, and then you're gonna choose to answer whatever you want from the comment and from the question. Someone asked if you could talk a little bit more about borrower-based measure and how they would reduce risk. Is that something that you want to address? Otherwise, you have plenty of comments from Steve to rebound on. And please ask questions in the Q&A if you want me to relay them.
Thanks, Pierre. And I can take and by the way, thanks, Steve. It's as always super enlightening. I took detailed notes of exactly what you were saying and transcribed all of it, including your suggestion for my further work on population aging as we move forward. I agree, it's not totally distinct. Now, to be fair, I think a couple of points just to reacting to what you said, which I think were all well taken. On a financial stability issue of slow versus fast-moving issues, what could make this fast versus slow? I do think the informational market failures aspect is relevant. I would concur with this. And I think one thing we had seen from previous studies, I hadn't listed it here, was that salience is an interesting one. Salience tends to have a shorter half-life than you would think. Think of just even the pandemic. It seems so distant to us now, and it was so salient not that long ago. Yet we've all kind of erased it from our collective memory and move on in ways which somehow have embedded some of the elements of risk management, but not all of them. In climate, I think in this respect, we are concerned if you have physical risk manifestation, and transition risk starts to also accelerate. Well, those elements could just indeed make it much more sense, and suddenly repricing becomes more potentially virulent. Now, I do think, irrespective of this, your point is well taken. I think it's understanding the exposures in the channels is the first element, and that many of those channels are in fact traditional ones, the traditional forms of financial risk. But some do look like they could be genuinely interesting, and that's particularly in the climate side, as you rightly picked up. I think the other side on the policy one, and I take to heart what you said very, 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 I think, seriously, which is, I think David Aikman himself said in a previous seminar, was in climate-related risk on the prudential side should not be a surrogate for missing industrial policy. And indeed, there's a lot of moving parts, and I think to overstep, not least just because of legal mandate issues, but even just Tinbergen issues, how would you reconcile? I think this work's been done also in the LSE and elsewhere, reconciling green and prudential objectives also in terms of the macroprudential ones would be hard to manage. And I think not only hard to manage, it would be imprudent to exercise this. And I think one of the things to be fair though is that in this world of irreversibility, this issue of type 1, type 2 errors becomes important with uncertainty. Do you take action that might be hasty, or do you take no action and allow the shock to play itself out? And we probably need to find a healthy balance in this respect. Now, on the tools themselves, I think this is the question that was asked, and also something raised by Steve quite forcefully. Borrower-based measures, I concur, it's a challenge, both from the perspective of, are these strictly amenable to climate change, and B, what is the social consequence of telling a low-income borrower that they're unable to access affordable housing because of their income status, or the value of their home, or the debt service to income question. These are complicated ones. The only reason I think we did raise it is, A, it's within the remit of many people's thinking about macro-pru measures, and B, some countries in Europe have actually been toying with it. So we thought we'd at least trace out the channels. But I do fear in the actual execution of this, you could also have a lot of collateral. And, you know, with policy, this is always an issue. Is the medicine not creating side effects, which are more important than the medicine that's actually fixing itself? So to be fair, the borrower-based one, I think, is a challenge. But I think to understand the channels it could play out and how that could be actually considered is not bad, also to inform the European debate, which seems quite active in actually implementing some of these. Yeah, I see other questions in the mix. I don't want to crowd out those in the chat, I should say.
I'll try to summarize it. It's the first and add one. So you talked about a bit about borrower-based measure now. There are questions about the systemic risk buffer. Also, what would you see how to deploy it, and question also that came around, you know, these tools are already existing in the framework. So could someone deploy them with the current framework, or does that need to change in the law or something like that for such tools, macroprudential tools?
Yep. So I think on the side of systemic risk buffers, I do think, and Steve had mentioned this too, you don't want to strangle transition finance. You don't want to push and exclude risks from banks to just end up elsewhere in the system. And in so doing, of course, it's not about the greenness of the financial system's exposures. It's about the greening, if you will. How do you move from these emissions-intensive exposures and help these borrowers in reducing? I think banks in Europe are really very strongly resident in financing. So if Europe wants to achieve its climate objectives, it does need to think about the role of banks and also managing financial flows in this respect. So the systemic risk buffer I think the deployment, the way we've been looking at it, is maybe a more targeted exposure, at least in terms of banks and exposures, to come up with climate relevant groupings. Now that is a challenge, because what we've seen is industrial allocation is not a sufficient statistic for emissions intensity. First of all, you can have emissions intensive or emissions very efficient firms in the same sectors. And anyway, if you even think about it that way, credit rating agencies are going to likely look to best in class. It's hardly likely they don't benchmark and they just blacklist entire sectors. So the shock, if it's back to the world of shocks, how might that impact in a quick way climate-related risk? This could be through some best in class versus worst in class being more finely differentiated. So systemic risk buffer might look at climate-specific groupings. Now, that would probably rely forward-looking intentions, forward-looking information. So transition plans are key here. Obviously, they're not fully on board yet in a way which would be systematized and effectively consistent. And I think this is something we need to really address. My personal view on this is that I think the more likely these are mandatory and also contain a lot of data, metrics, and targets, the better, because it'll really help in this differentiation process and also help to ensure some risk management is endogenous to the system. So climate risk buffer, just to be clear, I wouldn't argue for an immediate implementation. This calibration factor notion we floated is you could have a gradual implementation and you could also tie it to forward-looking measures.
There's also one question about, you touched upon the link between sovereign risk and so the impact on sovereign risk. So, I mean, if you want to elaborate on that, and there's also kind of worry about the limited fiscal space, no accommodative monetary policy at the same time, and climate on top of that.
Well, of course, I'm quite interested in climate and the greening in this particular presentation, but the broader issues related to the conjunctural setting on central bank QT, I don't think I would enter into in detail. It's not the focus of this discussion at any rate, whatever my thoughts. But to be fair, I think the sovereign banks nexus is an important one insofar as, again, there's, we know in the world of contingent liabilities that banks that don't manage this risk might become problematic in terms of the flow of liquidity, of lending through the system. So that needs to be addressed. And of course, the sovereign bank nexus, I think, is a key one. I'd abstract from central banks in this respect, largely, and just think about the idea.
Can I just make a short?
Yeah, I get Steve to jump in.
Yeah, Steve, by the way, if you want to answer.
He's less constrained than I am.
I'm less constrained. So I would say that that you do want to think about the sovereign bank nexus, but in the context of fiscal space that's likely to have to be used in place of insurance. And I think that's where I would go with this. And so the fiscal space then will save the banks, but it's going to save the banks by providing effectively federal government-based insurance for people that are harmed. I would also say that we could discuss the systemic risk buffer in a similar sort of way, right? Which is to say, oh, we have these regions of the world, and the particular banks are operating in those regions, and there's increased uncertainty about that's difficult to measure about the losses that they may face as a consequence of that, and so they should have higher systemic risk buffers. That's why that's the reason that I was talking about those as in the same way I would think about operational risk. Is that they're for things that you really have a very hard time imagining, but you do know that they're likely to occur should they occur in particular places and in particular ways. So that sort of the idea. On the QT stuff, I don't think this has much to do with the size of central bank balance sheets, actually. So I'll say for you that I don't think there's a connection there, but there is a connection to insurance and fiscal.
Thanks, Steve. I think these are excellent words that I think the last words, even if you will, Pierre.
Thank you. Yeah. In fact, we are actually arriving at the end of the presentation. A big thank you, Paul and Steve, for this particularly rich discussion. Let me just remind the audience that our next webinar will take place on March 25. It's Parinita Sastry from the Columbia Business School who will present her paper, Business as Usual, Bank Climate Commitments, Lending and Engagement. And this is part of the webinar series from the Young Scholar series. Thanks again, both of you, and thank you for listening to this webinar. And we see you in the next one. Thank you.
Thanks, everyone. Thank you.
Thanks very much, Pierre. Thank you, Paul.
Much appreciated.